All right, this is being recorded. I mentioned at the beginning of every single webinar, watch this again because, last time I did the long call diagonal, there were different scenarios to look at. We actually were able to build out one in the other long call diagonal where you could actually build this strategy out incorrectly, where you would be doing this for a debit that was greater than the width of the spread. And that's one thing that I have as a rule in this is how much we are expected to pay for this strategy in order to make it feasible to implement. So you guys will notice that throughout these webinars, I have several rules that you need to go by. Some of them have a little bit of wiggle room. I'm not going to lie. I usually say it's like a yellow light or something like that. If you start seeing you break outside of these different rules, and if you get too many yellow lights, you should move on to a different strategy that's probably more appropriate for your market assumption. All right. But let me get a couple of things out of the way for some of you newer people in here. This is on the long call diagonal, but my name is Eric Wilkinson, and I've been trading for over 25 years. I'm most known, I guess, for being called the Wolfman on CNBC. Joe Kernan used to call me that on the floor when I was standing next to Rick Santelli. But I started trading in college with some money I had earned and then decided to move to Chicago. In that time, I've traded everything from stocks, bonds, financial futures, currencies, and options on all these products in just about all market conditions. This is the disclaimer. Basically, it says, please remember past performance of any trading system or methodology is not necessarily indicative of future results. And this should not constitute investment advice, you guys. I'm not here to give you guys trade ideas, okay? What I'm here to do is teach you how to build an option strategy properly, okay? And it's up to you to implement it into your portfolio in your own way. And with your own market assumption. If you've been watching my daily market commentaries, you might very well be looking at me like, hey, you're crazy, and I have a different view, and I champion that. You guys should have your own views. That's what makes the market free market price discovery. All right. So keep in mind, this is for general education material. All right. And there is a risk of loss when you are trading with leveraged products like options, okay? Or any product, as a matter of fact. All right, you can follow me on at Twitter at Wolfman's blog or our parent company at ProTrader Strat. On Facebook, we have a website there as well where we put out a lot of content on the Facebook page, so you can follow us there and get access to that as well, all right? With this being said, we are doing this on the called diagonal spread, and we have a market assumption that is bullish. Now, I say neutral on there only because, in that first month where we're going to be selling a call, we're going to be selling an out-of-the-money call. And this out-of-the-money call, we don't want to really be breached, okay? There is a spread there, but if we want to go for the big money, we don't want this short call to get breached. And that's why it's a little bit more neutral. We want like a slow climb here. So we've had a big sell-off recently, obviously, major sell-off actually. And I don't know, I was under the assumption we were going to have a massive V-shaped recovery, but it is not looking like that's going to be the case the more this goes on. So, the long call diagonal, I do believe there is going to be a recovery because I think that there is a lot of value out there. And, just like when we were in bull markets, if you guys watch the daily market commentaries where I'm talking about all my trades and everything, I always say there is a bear market anywhere. Well, right now there are bull markets going on. There are things that are bullish. It doesn't really seem like it when you watch mainstream media, but there's stocks out there that are going to do very well in this environment. And those are the ones we're going to be kind of looking for going forward. So we just don't want a massive move to the upside. We are having really big swings. Yes. Are you worried? Well, maybe, but the fact of the matter is because volatility is so high, these out of the money calls and these in the money calls are, a little bit further away from where the underlying is trading. So we have to worry about the breach on the out of the money call. But in that case, it's just like a regular spread. You know, if it comes up and hits our out of the money call, well, that spread is going, our credit, or our debit is going to, when we sell it, be worth much more. All right. So that's what we're looking for. We don't care if it necessarily breaches it too much, but if you are going for the big money in the long run, you definitely would love to have this out of the money call expire worthless. So that's what we ultimately want, is to have that out of the money call expire worthless, and then the market kind of takes off. So we kind of want the market to do that. You know, in the meantime, this short call goes to zero. And then our long call that's way out in time for duration, right? Then it starts increasing in value. So that's kind of what we want to have happen. All right. So let me go over a couple of things. Our max profit on this, because it's a defined risk spread, it's the width of the strikes minus that debit paid. Because once it goes below our short call, we can't, once it goes below our long call, we can't lose any more money than that. So it's the width of the strikes minus that debit paid. Well, when we have a spread, our max loss, and we pay a debit for it, it's the debit paid. So we know getting into this what our risk is. That's one of the beauties of this. And the beauties of doing a debit is, generally speaking, when you pay a debit, you know exactly how much you can lose. You can only lose that debit you paid. And our break even is pretty easy to figure out. It's going to be the long call, all right? And remember, that's going to be the in the money call, all right? Strike price plus the debit paid. So right now, you know, like a lot of you guys have been reaching out to me. Some people have been taking advantage of the offer we've been doing lately and getting a part of our premium package. You know, you get unlimited access to me. Right now, you know, people are blowing me up because of what's going on. And, you know, a lot of my rules, especially when we get into this, you know, some of it has to do with the bid offer in a lot of these underlines. Well, with volatility as high as it is, like the last time we saw vol as high as it is right now was basically in 2009. You know, high volatility in the VIX used to be around 30. Right now we're in the 70s, and we even almost touched 90 the other day. So extremely high volatility right now. Well, what's that mean? The bid ask in all of these underlyings is getting really wide. It doesn't matter how much volume and open interest is going on in there. They're getting really wide, and it's making it very difficult for some of the newer traders to figure out what is value on this. You know, you don't want to give up too much edge in this market, but the people that are making the markets, you have to remember there's a lot of risk going on right now. So they're making their bid offers a little bit wider because they're trying to offset. The guys that are market makers are always trying to offset their risk. They're not just doing naked calls and naked puts, whether it's even short or long. They're always going in and trying to offset it with either a spread with another option, or going out there and try and buy that underlying. Well, with these kind of volatile markets, you know, the underlying can move in dollars within seconds. So they're trying to compensate themselves for that offset of risk by making the bid offer a little bit wider. With this strategy, though, we're going to be able to build it out, look at what our debit paid is, add it into this long call strike price, and that actually, if we have that break even, it should equal where XYZ is actually currently trading. All right, it's the current price of the underlying. So we want to get as close to that as we can. A lot of times with building out this strategy, guys, it's going to be slightly less than where that current price is trading. So in a sense, you're getting long at the strike price plus that debit paid. Well, that's going to hopefully be under where the current underlying is trading. You don't want to pay like $1 over where the current underlying is trading. If you are doing that, you're setting this strategy up incorrectly. And we're going to beat that to death in this webinar. All right. Volatility can break the even. This is obviously at expiration. Because we're doing two different months, right? That volatility can fluctuate differently in those 2 months, and that can actually affect your break even a little bit as well. So hopefully in this environment, the way we're seeing it, volatility affects further duration option expiration cycles more than the near duration. Okay, that's the rule of thumb. That's like almost a pretty good given. Well, recently that rule is thrown out the window. You almost can't find anything that has higher volatility 90 days out than what we're seeing here in the next 30 days. So it's expected to go down, which seems pretty intuitive, but if we haven't seen this type of volatility in 12 years or something. So it is expected to go down, but that helps us here because we're buying a further duration option and we're buying low volatility. And in this front month that we're selling that has extremely high volatility, we're getting paid for that volatility in that front month. So it helps us out a little bit. And I'll explain all that a little bit more as we go along. But I do have some rules, like I said, when we're setting this up. This is how we're going to be successful with this strategy. And of course, I've got picking the right underlying. And usually what I talk about with this is if it's less than $100 stock for some of you newer guys, if it's less than $100 stock, then the bid ask in the option montage and just in the out of the money option bid ask should be equal to or less than 10 cents wide. Now that's my general rule for that. We're not seeing that happen right now. All right. And I would say that normally speaking, if it's greater than $100 stock, the bid ask should be equal to or less than, moving the decimal 3 ticks to the left. So let's just say, for an example, if it was a $295 stock, XYZ is $295, then we move that decimal place 3 ticks to the left, right? Then we're looking at, 29 to 30 cents is what we would normally be looking at. Right now, on a $295 stock, it's basically you're moving it twice. They're like $3 wide right now. So they're pretty wide, right? And that's a bit scary. That's what I'm talking about. How do you price that in when options are that wide? Well, with this strategy, like I said, we're going to be looking, you're going to look right now to make sure, look to see your break even. Look to see if break even is equal to XYZ's current price. Not a very good writer. All right, so basically everybody got that. We're going to kind of build this out so it looks like XYZ, those long calls plus that debit paid is right there at about where the underlying is trading. That way, we let the market trade it out. We don't have to worry about giving up edge and all of that stuff. We know that we are buying our underlying at value. All right, we're buying our calls at value if we can do that. All right, now the environment here, what we're talking about is we have 2 expiration cycles. All right, so if I say, expiration cycle June, this is 29 days to expiration, and that's the M is what we used to use on the floor. And we're going to be kind of looking at April as well. All right, so April is about 90 days. I don't know right off the top of my head. This is our example of what we're going to be looking at. What we want is volatility. We want the volatility difference to be less than 2 to 3 percentage point increase to the April. All right. So meaning June is usually, like I said, volatility usually affects these April more. So what I would say is if June was trading at around 35, let's say, then the April should be less than an increase, should not be more than 38, all right, on the vol. Should be less than like 38. So that's like an example of a normalcy. Right now, what we're seeing is, this is, 50 and this is 45. Well, it's gone down. So this is what I'm saying. We're buying this call and we're selling this call. So we're getting paid for volatility in the front month, so we don't have to necessarily worry about it. But in normal circumstances, the rule is we don't want volatility, we want it to be somewhere around 2 or less than 3 percentage point. So less than 3 percentage points increase to the back month. All right. Does that make sense? Here, I'll pull up let me pull up the platform real quick. And it's probably not going to help a whole lot, but because you'll see the other example. So let's just take a look at Clorox for lack of a better, lack of anything else. So I'll pull this up so we can have a pin going here, and I'll do it in red. So here's our volatility over here. Shoot, why isn't volatility showing up on this? Hold on, let me just make sure I scroll this to see vol. All right, I'll open this one up and go to there. That gets it up. So what I'm talking about here, so we got Vega right here. That's just volatility, all right, and it's for this particular underlying. So what we are going to be doing is, since we're selling a call here, all right, and we're going to be buying a call, out here somewhere, we want to make sure that this volatility here does not go up by more than 2 to 3 percentage points. All right, you can see it's a negative. So it's gone from 74 to 72 and 69. So in most circumstances, like in normal markets, this might be 74 and this would probably be like 77 or something like that. Okay, we're not seeing that right now. It's going down, so that's okay. That doesn't really meet that, or that meets that rule, right? It's a negative volatility difference rather than a positive, which is what's normally assumed, is that it's going to increase in those back months. So we're not seeing that happen. And a lot of times what I'm talking about with this in other webinars is ID percentile. We don't have to really worry about this because we're offsetting a lot of this volatility in setting this strategy up. We're going to be buying this call for value. So we're getting rid of a lot of the things we got to worry about with like theta decay and stuff like that. We're going to basically, the in the money options have intrinsic and extrinsic value. So the extrinsic value is all of the stuff like theta and vega that go into it, right? That's what all the extra pricing is that is involved in the money options. Well, because we're selling this near duration call here, we're going to try and pay off with all of this extrinsic value. We're going to try and pay off the extrinsic value of the in the money option we're going to be buying. All right. So we're going to basically be able to get rid of the worry of theta contraction and volatility moving around because we're buying the strike for what it's worth. So for instance, like these 85 calls right here that are in the money. Well, we know that 85 call is actually worth what? $6.78, right? $6.78, because we see the 185 to 191, the difference is $6.78. All right. You can see that there's a little bit more pumped into that with the puts getting all skewed out. There's a lot of volatility pumping those up. So out of this $21, the value is $6. So we can see that these in the money options have that difference. So basically somewhere between $10 and $15 of of extrinsic value, right? These 85 calls coming across here, they're priced in at $21. Well, we know they're only worth $6.78. And that means the rest of those in the money options have extrinsic value. Now, a floor trader hack that I'm going to give you right away is if you're buying in the money options, you can look over at the corresponding puts that are out of the money, and those are a good representation of extrinsic value of the in the money option. Okay, that's a floor trader hack we used to use. And that is a pretty solid rule. We can see just by the pricing, if we know this is 678, we can see it's basically pricing in $10 to $15, really wide. I mean, and it's after the close. So, you know, those are crazy wide markets. We're after the close. Clearly doesn't fit my rule like normal. If I move the decimal place 3 ticks to the left, normally speaking, I would say they need to be 19 cents wide. Well, we're not getting that anywhere close. And these options during open market are probably going to be somewhere close to $1 to $2 wide at this point. All right, but again, like I said, when we build this strategy out, we know we're building it out to be getting these calls at value. So, you know, in a sense, if we did this spread, ultimately we would be thinking we're paying a debit of $6.78, right? Because I told you that the break even is basically where we want to kind of buy these calls in at, and that would equal it out. Have I lost anybody yet? We get this, right? So I've talked about a couple of things there. But the volatility, if it goes down the further out you go, it's a total green light. If it increases by 3 percentage points, then that's a green light. Basically, if it increases by 4 percentage points or 5 percentage points, it starts to be a very yellow light. So we start worrying about that because we're buying volatility, which means that call we're selling that we're not getting vol for is going to be pretty close to the market, and the one that we're buying a lot of volatility in is going to be really deep in the money. So that starts increasing our risk, right? Because now we're buying deep in the money and paying a lot for this spread. We don't want to have to do that. So I'll have a lot of things in this webinar where you guys are going to be able to avoid some pitfalls that are normally showing up. I need to go to something where it's a little bit more realistic, like let's say SPY. And that was something I've been talking to people about, you know, especially with these wide markets. If you are getting involved in these ETFs right now, not that I love the ETFs for a directional move right now, because we know what kind of environment we're in right now. And we kind of know what's going to be doing good. Like Kroger, there's lines out the door. Costco, there's lines out the door. I've been saying, you know, like EA Sports and Activision have been getting beat up. Well, you know, a lot of you guys that are self-quarantining and may have kids, what are they doing right now? Those guys are pounding on the computers, all right? They're buying games, you know, can I buy a new game every friggin' day, it seems like, right? And the other thing is people are buying home computers, right? And for school, for their kids. But another thing that they're doing is they're working from home. So they're getting cameras, they're getting another screen, and they're buying different ancillary things to build out their home office, right? So those are areas of the economy, or those are companies that I would be kind of looking at for this type of strategy. I think I would stay away from the biotech, because if somebody cures this thing, then, you know, we're talking like it's going to be hailed as like the curing cancer at this point, it seems like. All right, so let me move on. If I can shrink this down a little bit, let me blow this up so then I can shrink it. All right, so that's the right environment. Usually a less than 3% increase is that green light. 3 to 5% is starting to be like a yellow light on this, all right? All right, now our duration. We want to pick the right duration on this because, right, we want to sell a call that this is theta decay. We want to get rid of that short call as fast as we can. So if we sell a call here and we get this theta decay, that means this call goes to zero faster, right? Well, and then we buy this call out here. Well, it holds on to some of that theta decay, right? And will retain its value longer. So we want to buy out here. You know, I usually say when we're buying this for the duration, buying that right duration, I'm usually saying that our duration here is, you know, in the front month, the one that we're selling, we sell days to expiration kind of equal to about 35 days, whatever's closest to 35 days to expiration. And then the one we're buying, we're getting further out. We're going to go like, you know, plus 65, you know, like 90 days is kind of usually what I'm looking at. All right. So further duration. You can go even further than that as well if you want to, as long as it fits the rule of picking the right strike. So as you can see, if we're buying or we're selling inside of this 35 days to expiration, anytime you're selling options, this is what you should be looking at. And then when you're buying it, we're going to be basically getting out here where the theta starts slowing down. You can obviously see theta decay on any given day is less than what we're seeing out here. And we can even pull it up on the platform. Give me a second. I'll pull up on the platform. We can see the theta decay difference. So like I said, we're kind of looking at these 90 days on this one here. And, you know, the reason why I like getting out here, look at the difference. We're talking a difference of 4 down, which is kind of crazy. So if we look at the theta decay here, you can see inside of 29 days, we have 28 cents, but the one we're buying only has 15 cents a day. So we're gaining 13 cents a day on our strategy if nothing else happened. Okay, I mean, obviously, I don't expect day after day the SPY to still sit here at, you know, 240, right? But to wrap your head around what's happening with your strategy is that front month is decaying faster than that back month. And, you know, our strategy, all else being equal, is gaining 13 cents a day, right? In our favor, because this theta, the one we're shorting, is losing value faster than the one we're buying. I've been wrong about straight calendar spreads. Now, what do you mean? Now, this isn't a calendar. This is similar to a calendar spread because you're using 2 different months. But when you're doing a calendar spread, one of the things, especially in this type of environment, the calendar spreads, you're using the same strikes. So the beauty in this one is we're using different strikes. It gives us a spread rather than with the calendar spread. You know, if you kind of with a calendar spread want to be wrong right away and then be right in the long duration. So you want the market, you know, with this one, with the called diagonal is how we would write it on the floor. You know, you don't mind if it kind of trickles up like that, and then get that move is the best case scenario. With the call calendar, you kind of want it to do this and then get that move, right? Because then in this time, you know, 35 days to expiration, that short call goes to 0. Here you're giving yourself a little bit of wiggle room to the upside. Okay. All right. And then our strikes. All right, we're picking the right strikes. This is pretty important. Now, a lot of times, I would say, you know, if you're doing a 16 delta, like you're worried about this market like moving higher and hitting your short call. If you're using a 16 delta, if you're selling the 16 delta, let me get my eraser out. If you're selling that 16 delta, for selling that 16 delta, come on, Pan, work with me. If you're selling the 16 delta, you're basically going to be having to go on the out of the money, 16 delta, which is the out of the money, right? That's that near duration. Then the one that you're buying, you're going to have to basically be buying about an 84 delta, which is pretty deep in the money right now, right? And with the risk that we're having, if we're wrong, that can hurt. So we're also can look at like somewhere between these two. So it's going to be pretty commiserate, really. So if we're looking at like the 36 delta, than selling the 36 delta, then we're going to be looking at buying the 75 delta, which is a little bit closer to where we're trading and might be able to limit some of our risk to the downside. Bottom line is this one, obviously, here you're going to get paid more for that width of the strike. You're also risking a little bit more. Remember, anytime you're risking something, you should have the reward. Well, if you're risking more, your reward should be more, right? In this one, I would kind of suggest leaning towards this one in this scenario or in this environment to limit your risk a little bit. And, you know, obviously, I always am looking to hit singles and doubles. I don't usually swing for home runs. Every once in a while I will. But I like to have consistent, you know, singles, doubles, and win the game that way. So this is where I was talking about where we're also building this out. This is what I wanted to talk about here. We don't want to have our debit. We want our debit. I guess I could just write it out. Debit. We want our debit to be less than 75% the width of the spread. All right. So for instance, if our spread between the 2 months here is $10 wide. So let's just say we have a $10 wide spread, right? Then we would not want to pay more than $7.75 or $7.50. We don't want to pay more than $7.50. All right. So that would be the max we would want to pay on a $10 wide. I'll show you how to build that. When we pull up the platform and really dig into it, I'll show you how to build that out a little bit better. But so we don't want to pay a debit that's greater than 75% the width of the strikes. And also picking the right strikes. Remember, we want when we build this strategy out, we want it to be equal to where XYZ is currently trading. All right. We also want the debit, the long call plus the debit equals where XYZ is currently trading or below, right? We don't mind buying something. We don't mind buying XYZ below where it's currently trading. Is there a minimum or maximum width to the spread? There isn't. Usually, you know, everything's commiserate. With volatility as high as it is, our spreads are going to be a little bit wider, right? Because as volatility expands, you know, let's just say in low volatility, low vol, all right, that 16 delta might be very close to where XYZ is currently trading, or the 30, you know, I should say 36 delta and 3 delta or whatever is going to be very close to where XYZ is currently trading. And high volatility, you know, if it's really high volatility, that 36 delta is going to be like out here. The 16 delta is going to be like out here, and like the 3 delta, kind of like that, to give you a visual of what's going on there. All right. So it might be the same XYZs, low volatility XYZ and high volatility, but you know, the call strikes on the montage start looking like that. Okay. Does that make sense, Trevor? I've been using horizontal and out of the money calendar spreads and wondering why I don't make so much money. Well, Jim, I'm going to be doing the calendar spreads next week, so you should stick around for that as well. All right, so following these rules, right? Picking the right underlying, the right environment, the right duration, the right strikes. All of these things build out, and we, you know, do not want to pay more than the width of the spread. So, you know, there are scenarios in other webinars, and I haven't been able to find any in this type of environment. Why? Because volatility is so much lower in the back months. Usually, when it starts breaching that, it's like 10 percentage points higher in the back month, you can actually set the strategy up where you have a $10 wide spread and you're staring at paying $11.50. Why would you do that? It doesn't make sense. There's better strategies for that type of environment to take advantage of your directional assumption than the spread. So that's why I always say this is key. Your debit is less than 75% the width of the spread. All right. And to give you an idea, as if you're looking at like a 16 delta, you're going to have to go deeper in the money for the 84. And if you're doing the 36, it's about the 75-ish, especially right now. Okay. All right. Also, knowing our exit strategy. I say as soon as that, the short call, as soon as our short call is touched, we're looking to get out, right? Short call touch, I'm looking to trade out of this one, all right? If I get it on, and also, whatever, if this call expires worthless, and, I basically got my underlying for that money, I have no problem looking at like your Fibonacci's or, your technical analysis or things of that nature, even building this strategy out like, okay, there's a resistance area up here at the, the 50%, it's probably 50% extension at this point. If there's, and that strike is the 50% extension is like $75, and you're like, okay, well, I'm going to short the 76 calls, and wherever that delta is, whether it lands in between the, what my parameters are, somewhere in between 36 and 16. Maybe all of a sudden, well, if I'm able to sell the 16 delta up above that resistance area, that's where I'm going to look for. All right. And that's usually how I set this strategy up is I look to where that short call is, and then start building from there. It's quoted as the back month to the front month, and that's because you're paying a debit. But I always, when building this strategy out, will look at the front month in order to figure out where my strike is that I'm going to be buying. So I mentioned, and this, I'm looking at Kroger, all right, because I think that Kroger is going to do very well in this environment. Now, my first thing to do is look at, all right, it's less than $100 stock. The bid offer should be close to 10 cents wide on these just out of the money options. The closest monthly to expiration, which is basically usually around that 35 days to expiration. Right now we're at 29. So this would be one that would fit. I would look to fit that rule on picking the right underline. Obviously, it's after the market. After the market, everybody cancels their orders. They get a little bit wider. So that's during a day session type of scenario. It's probably not going to fit that rule right now in this environment. All right, so let's do 60 days to expiration, or 60 strikes. Give me some of these, give me more strikes. My next thing was picking the right environment. We need to make sure that this volatility is not going to expand by more than 3 percentage points to this one, or 4 percentage points. Well, we can see it goes down by a lot, right? I mean, we're talking almost 30 percentage points less. So you'll be able to see that the theta also decreases as we go out here in time as well on the puts and in the calls. We can see that the theta goes down, right? Now, volatility affects the premiums more further out in time, which is the rule of thumb. But the fact of the matter is, it would probably usually be a little bit more, maybe. But the volatility is so pumped up in these front months, we know that we are selling high volatility and buying low volatility, which is ultimately what we want. All right. So I started betting some of these because I knew these markets were going to get wanky after the close. So I was looking at with Kroger trading probably right around 34-ish, right around here, right around where, maybe a little bit higher. It looks like it sold off a little bit. All right, so first thing I'm looking at is selling the April. So the April contract, I usually kind of look at this and say, all right, the April 35 delta, all right, that's the one I'm going to go a little bit closer so I don't have to go so deep in the money. So the April is all extrinsic value, right? Because that's the out of the money option. It's out of the money. That means it's all extrinsic value. Now the in the money option that we're looking to buy, right? I said we're going to be looking to buy an in the money option at around 36. So we're going to be looking at about that 75-ish delta, which probably is going to be this one, only because I'm looking across the board at how much of a collection I've got. $1.20. That means that these 28, we can figure it out, 28 to 34. The intrinsic value, what it's worth, is $6.50, let's say, right? Because from 28 to 34.50 is $6.50, right? If I'm not correct. So you can see the bid. Somebody's like, oh yeah, I'll pay exactly what it's worth. Well, we know that we need our total debit to be about $6.50. So we add $6.59 to 28, right? And we get about 34.59. So we're landing right in between the bid offer. So we know we're priced pretty appropriately, and there's no problem. Like, you know, since you know the markets are a little bit wide, one thing I always say is, like, you know, it doesn't cost you anything to put an order in and not get filled, right? So I, especially in these markets, would go a little bit further away because you're taking on the same kind of risk of the underlying moving back and forth. Throw it in there and see if it gets filled. There's all kinds of mispricing going on. So you might, and that means I would be buying this right there very close to where the bid is, maybe even slightly less. So put it in there, and then, you know, if you don't get filled, by the time you come over, cancel, replace, change your price, put it in the market. You know, that's enough time for everything to sort out the trade, because especially in these further duration months, you know, there's algos in there trying to auto leg spreads, and they're doing the same thing for you. When you throw this in there, it's trying to say, all right, well, I'm willing to sell this 38 call at a price wherever the offer is to buy the 28s. Like if the offer in the 28s is actually, the 38 calls that are out of the money, you know, are at 46, right? And the bid is 28. Well, I want to sell these 38 calls at 120. Well, that means that my bid, you know, the computer's going to figure out my bid is based on that. So it will actually say, if I'm willing to buy this and sell those for $1.20, I can sell those for $1.20 because I know it. That means my bid is going to be will be trading right around $7.70, right? My price of, I hope I didn't lose everybody on that one. These in the money 28s, like if I buy $7.70, if I bid $7.78 and then sell these at 120, that means I got my price for $6.50, right? That's how spread works. That's actually how I got started, you guys. Is I'm pretty darn good at figuring out spreads and pricing and stuff like that. So that's how I made my name in trading in the Fed funds. Is I was a whiz at that. I could see mispricing all the time. Like people would come in the pits and be like, "All right, I'm at $7 for the 28 calls, the June 28 calls. I'm at $7. I'd be like, sold. And then I'd go and sell these calls here at 120. And then I'd go in here and hit this guy on the spread. Basically just made 50 cents, right? Because I know that the pricing should be a little bit higher there. This guy is willing to pay $7.70. and sell those at 120. So I buy these at buy these calls at $7, sell those 120s, and then hit this guy on the spread, and I just basically leg the spread better than what he did. That makes sense. Sold him the spread. So I'd make the 70 cents. But now with the day of computers, this computer is actually going to go in there and automatically, immediately bid $7.70 because he knows he can sell these at $1.20, and it'll auto leg it for you. Okay. I got a little bit deep, a little bit heavy for you guys on that one, but so for instance, so now we know that we know where our break even is on this, so we're pretty sure we're picking the right strikes. We know we've got the right duration. We went over all of that stuff. The last thing we really need to do is figure out what this credit is, $6.50, right? Or sorry, what this debit is, and divide that by the width of the spread, which is $10. And obviously this one's pretty easy to figure out. 65% the width of the spread. That's less than the 75% I talked about. So that works for this strategy. Now, going a little bit further, if you wanted to play this for an earnings play, which is what we sometimes talk about, and we're looking at Kroger. Kroger has the earnings in not this month, so we're selling this month. You can see it's clean, so that's another thing we want to make sure of, is we don't want to be selling this calendar spread necessarily that front month where there's a binary event like earnings, and I think I forgot to mention this in the put one. So if you guys were watching both of them, you guys are getting something I forgot to mention. So, and there's nothing going on here, so why not look at the ones that have that binary event where it's going to come out where I believe, in this time, Kroger is going to do very well and is going to knock the earnings out of the park. Well, I might want to take advantage of that move, right? I see your question real quick. Let me get this out of the way as an example. So we're skipping that one. So the June, let's look at that July expiration. So the July, we're probably going to have to pay a little bit more of a debit and go further in the money, but let's start out with selling these same Aprils because it's that 36-ish delta, somewhere in between the 36 and the 16. And then I'm going to have to probably go to, so I'm getting about $1.35 or something like that. So just look over here and say, normally during open markets, you're probably going to look at this one and say it's the 27s. And add this 20 debit in there, $7.74. That puts us at $34.50. This one in particular, 34.47 is below where the current underlying is trading. So we know we're good there, right? We know we paid off all the extrinsic value. If this debit plus this credit is equal to or less than where the current underlying is trading, we know we paid off the extrinsic value. So we don't have to worry about this being $3 wide and this one, being a little bit wider than what I normally would say. We know that we can get this long call at value because the debit we're paying plus the call strike should be equal to where the underlying is trading. That means that we're getting it for value. The next thing we would need to look at is, now it's $11 wide, so the math isn't quite so easy. $7.47. Divide that by the $11 wide spread. It needs to be less than 75 cents or 75%, and you can see that it's at about 68%. So that fits the rule. So I would say that's a green light to go ahead and send this off. Now, if the underlying trades up to my 38 calls and hits it, and we are trading 38 tomorrow, that's when I'm going to look to cover this spread. A lot of times I'll say, 50% of max profit is what we're looking at. So if we're paying $7.47 on $11 wide, then we're looking at $3.50. So, half of that is about $1.75. So you add in $1.75 to this pricing, and that's when your credit is worth what did I say? So $9.25. When this debit increases to $9.25, that's when I would look to get out also. Okay. So that's what I would be looking at. I kind of like that other one where I like that because also at $38 or that 38 call that we're selling is above this spike. So, that's pretty good. A lot of people are speculating on Kroger doing very well right now. So all of those things working in our favor. It's kind of already priced in. So I don't know that it's going to spike up there. I don't know that Kroger can get any more busy. They showed their warehouses today. They were like, oh, yeah, we got plenty of stuff in this supply chain. You guys don't need to worry about us running out on the shelves. There's no sense in hoarding. It's going to still be there. May have been a good thing or a bad thing. I don't know. So it's not the net debit. It's the ratio of the long call to the spread. Yes, the long call, I think. The debit paid is important because the debit paid plus that long call should be equal to where the underlying's trading. Okay? But the ratio of the spread, we don't want to pay more than 75% to width the spread, because then it starts being like, okay, I'm risking way more than what my reward potential is. And some people, and in some instances, sometimes you're looking at, an 11 or a $10 wide spread and the debit paid is like $11. And some people teach that. And that's absolutely wrong. You need so many things to go in your favor in order to make money in that type of scenario that it's not worth it. It's absolutely not worth it. And this one, we can take 50% of the max profit. The market comes up and trades to 38. You're going to probably, if this market comes up and trades to 38, we are probably going to be very close to that 50% of what the max profit is, where I would cover. All right. But this market just starts trading sideways. Those calls expire worthless. I have that call on for what it's worth for the next, 120 days. So it's kind of like you're getting long the stock as well, right? Because I'm buying the call for what this is worth. But, if it goes below my 28 calls, I don't have to worry anymore. It's, my debit's gone. So you kind of have a synthetic stop order in there also. You're not losing any more money if it falls out of bed. That makes sense? So it's pretty simple. Just make sure you follow those rules and you will be good to go. And like I said, I know I went over a lot of stuff and some people's heads are probably spinning right now on this. That's why I say watch it again, because you watch it back through and all of a sudden the light bulb goes off and you understand it a little bit better. And not only that, you will remember it longer if you watch this again, because I have a lot of different rules that you're not going to find online. You're not going to go online and find on Wikipedia what the strike location is. They're just going to be like, you buy a further duration option and you sell a nearer duration option. And they're not going to talk about like the width of the spreads and the amount of debit you should be expecting to pay for and pricing and all of that stuff. So make sure you take that into account. In this example, if the stock goes up to my short strike, what is my residual value? It's hard to figure all of that out with volatility and everything else, but your residual value, if it goes up and hits that short strike, the value of the debit is probably going to be very close. It depends on how fast it happens. If it's tomorrow or a week down the road or 2 weeks down the road, because of the volatility, the theta contraction. But if it goes up and hits your short strike, that's where I'd look to cover it. And it's probably going to be very close to that $9. All right. So this is the offer we're giving you guys. I'm going to throw it out there in the chat window. We've been going back and forth in the in the questions box. I got the link over there in the chat window. This is the premium education service that I was talking about. You know, you guys get the daily market commentaries where I talk about all my trades, when and where and why I put those on. Win, lose, or draw, you guys. I talk about the losers as well. I'm not the guy that cherry picks and says, oh, yeah, you should have done this one. Like some of the guys on mainstream media. If I'm losing on a trade, you guys know about it. And I'm talking about how I'm staying mechanical with that. What I'm doing to lower my cost basis to increase my probabilities of success. So those are in the daily market commentaries. You get that. You also get access to me. One thing I don't think we have written down here is and a lot of you guys that have taken advantage of this education service is that, if you have a problem and have a question about something, whether it's working out or whatever, I will talk you through that on how I would do it. I can't tell you how I think you should do it, but I can say if I were in this situation, I would do it. Also, you get priority access to the workshops and the trading course. Basically, the trading course at this point is hundreds of videos. Like I said, some of these put diagonals or the call diagonal is repeated for like intermediaries. All right. So these courses are designed a little bit differently, and I talk about things in those as specific to people that are starting to learn and building it out that way. So you can not only just watch this one again, you could watch a different one in one of these other courses that are basically geared towards these specific things. So you will get access to these. You watch the short straddle over here for the neutral bias one, and it gives you a check mark. Or if you've watched half of it, it will show you that you haven't watched all of it. And you can kind of jump around. So did I watch that one? Well, you'll know because we've designed it so you can do it. Here's the link right down here. If you're watching this on tape delay, you'll have to pause this. But if you're watching it live, just go ahead and take advantage of the link over there. So you can add it to the cart by clicking on the link in the chat window, or when you punch this into your URL, you can take advantage of it. But all of those for $97 a month, it's not like you lose them. You get to keep watching them over and over again. You're going to basically have a master's degree when you're all done. Seriously. I have talked to options professors, and I'm telling you, I probably could teach them a thing or two. And I know that I can teach the guys that are talking on TV under the table with options. They're constantly giving bad advice. It's free, but it's bad. All right, so take advantage of that. Make sure you guys click on that link. Appreciate it, especially if you learned anything at all. You like how I teach, what I'm saying makes sense to you. All of those things are added value to you, all right? So I just want to thank you guys all. Later webinars, I'll drill down. I see a couple questions popping up. I'll hit those here in a second. Different options, trades, when and where I find those appropriate for myself. Here's also the link, Pro Trader Strategies, Premium Options Education Service. Again, that's not a hot link. You'll have to type that into your URL. If you have any questions, or you see or know of a strategy that I haven't possibly covered, or you want me to do a webinar on something, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. James Rooney, TV advice is free, but worth twice that much. I'm telling you, TV advice is free, but it's going to cost you. Is really what I would say. It's going to cost you in the bad advice because it's going to go against you. All right. So, one last thing I have to do these days is make sure that you guys are very aware of the big disclaimer. And the big disclaimer, there is inherent risk in trading. We are an educational company. I am not giving you advice, so please read over this. Hypothetical or simulated results have its inherent limitations. All right. So make sure you take this and read over it. I'll answer a couple of those questions real quick. Thanks so much, Rick. Oh God, you didn't catch me off guard today. Thank goodness. Do I have to watch every day, or can I put some kind of stop loss order in this? You don't need a stop loss, Jim, because that long call, that in the money long call, has a synthetic, stop loss in it, right? Because we pay a debit, we know what our risk is, and if the underlying goes below our long call, we have no more risk to the downside. So you don't have to. It's got a synthetic stop loss because that long duration call is the one we're buying. I won't teach the short call diagonal. It does not make sense. It does not fit my rules or what I believe. A short call diagonal, if anybody tells you that's a great trade, just be like, think about it. You're selling an option way out in time, and you're buying one that's in that theta decay zone. So I don't even teach it. But yes, you don't have to worry about it. Going into it, your debit paid is what your risk is. Now, if you're looking at something like doing this on the SPY or the SPX or something like that, where you're paying, hundreds of dollars for that long call, then something to know, I would say you would want to say to get out at 50% of your debit in that instance, because that's a lot of money. So if you got a drawdown of 50% of that debit paid, you could say, all right, that's where I'm pulling the trigger also to get out. Yes. That TV advice will probably cost you more than my subscription on one trade. I mean, if you watch each one of theirs, and they only tout the ones that are winning. That's the funny thing. Is like they'll say, "Oh yeah, I've got this, that, and the other thing," but then all you see is we were up 300% on this one strategy. Okay, what about those other 10? All right, that's all I got for you guys. Link is in the chat window. If you're watching on tape delay, the link is up here at the top that you'd have to punch in there. That's all I got for you guys. Other than if you can't take that, take it easy. Thanks, Jim. Appreciate the kind words. See you next week. Or see you tomorrow on the Daily Market Commentaries. Whichever's first. Bye for now.